Why do experienced investors choose individual bonds over bond funds? Let me show you. It's the shocking truth about bond funds and bond ETFs that Wall Street doesn't want you to know. We're about to dive into the world of individual bonds and share why those bond funds and ETFs could be giving you a false sense of security. Most people on YouTube, when they give a mention to bond investing, immediately stray into bond ETFs and bond mutual funds. It seems like an easy way to quickly get a diversified portfolio of bonds. Just set it and forget it, right? Wrong. However, while we've done a nice job on the diversification front, you have totally left yourself exposed to the volatility of the interest rate market. Some suggest that it's almost as volatile as stocks, just without the potential upside. Today we're going to explore how individual bonds could remove some of the volatility in your investment portfolio. First off, what exactly is an individual bond? Think of it as lending money directly to a company or a government. They promise to pay you back with interest, kind of like when you lend money to a friend, except a lot more reliable about paying you back. I'll put a card in the corner to walk you through some bond basics. Now let's break down why individual bonds trump bond funds and ETFs. 1. Predictable income. With individual bonds, you know exactly how much interest you'll receive and when, unlike that of the bond mutual fund or ETF, whose income can fluctuate like a yo-yo. 2. Guaranteed return of principal. When you hold an individual bond to maturity, you get the face value of the bond that you've known since you bought it, unless the issuer defaults, which is very rare in high-quality bonds. With bond mutual funds and ETFs, you have no way of knowing what it will be worth at any point in the future. Unless you're seriously into mysteries, this sounds a lot like volatility again. 3. Known rate of return. Buy an individual bond and you can calculate your exact return if you hold to maturity. With bond funds, your return is as unpredictable as a weather forecast. Both the value of your investment and what it will pay you are unknown. 4. Interest rate immunity. Hold an individual bond to maturity and market price fluctuations don't affect your return. Ever wish you had an umbrella that keeps you dry no matter how hard it rains? Individual bonds are just like that. Now let's address the elephant in the room. What about diversification? Isn't that why people choose bond funds? Well, here's a little secret. You can create your own diversified bond portfolio, kind of like being the chef of your own financial meal, instead of ordering a pre-cooked dish. Because you have so many different types of bonds available and types of risk, you have super safe like U.S. Treasuries or U.S. government agency bonds, almost as safe municipal bonds, which are often exempt from state, federal, and local taxes, and corporate bonds, or even certificates of deposit or CDs. Talk about diversification. With equities, you're just invested in the business world. Individual bond investing takes diversification to a whole new level. Let me take you behind the curtain for a minute. Having spent more than 30 years as a bond trader, I've sold bonds and bought bonds from mutual funds. What do you think the managers of the investments in the bond mutual fund are trying to achieve? Are they focused on providing you with stability and certainty in your portfolio? Not at all. Ready for this? They're focused on capital gains. They are judged by the return on their fund, and they've got to do better than the interest rates on the bonds they own. Otherwise, why would you buy it? That should make you sit up and think, what? If I want capital gains, I'm going to invest in equities. And you're exactly right. What that means is in up markets, they're taking profits. But that means they're reinvesting at lower yields. Take it one step further, when the market turns against them, it turns hard. And you actually, the investor, get clobbered, and they struggle to get your price back up to where it was. Here's a surprising bonus about individual bonds that most people overlook. When you buy an individual bond, they typically pay interest every 6 months. With that in mind, as you're buying your first 6 bonds, get a different interest payment month. For example, January, July, February, August, March, September, and so on. We call this a check-a-month strategy, and it can be incredibly powerful for someone living on a fixed income that needs a consistent stream of income. I'll put a card up in the corner with a video explaining this in more detail. If you're finding this as riveting as I do, and let's face it, who doesn't get excited about predictable returns? Go ahead and hit that like button. Subscribe to the channel so you don't miss future videos, and this channel will continue to grow at no cost to you. Now let's address some of the common objections to individual bonds. They require a lot of money to invest in them. While it's true you might need more capital to start, one of the safest investments you can make, U.S. Treasury bonds, are sold directly by the U.S. Treasury, ironically, on the Treasury Direct website, and they will let you invest in amounts as small as $100. We'll link to Treasury Direct in the comments below. They're too complicated. For most of my career, when I told people I was a bond trader, they thought I was some kind of wizard doing all kinds of magic that they'd never understand. It's simply just not true. Bonds are actually quite simple. Before you buy a bond, you know exactly what you're going to get and when you're going to get it, both interest and principal. I promise, once you get it, you'll wonder why you ever use training wheels, aka bond funds. What about default risk? Stick to high quality bonds, and default risk is minimal. For example, the default rate on municipals is less than half of 1%. That was even the case during the Great Recession back in 2008. What's your objection to bonds? Put it in the comments below and we can discuss it. Here's a professional tip from my 30+ years of trading bonds. Always match the maturity of your bonds with when you think you'll need the money. If you need cash for college expenses in 5 years, buy a bond that matures in 5 years. This way you're not forced to sell at a bad time or take a loss. It's all about planning ahead and locking in those returns. You can't do that with any kind of fund or ETF, whether it's stocks, bonds, or whatever. Individual bonds offer stability, predictability, and peace of mind in your investment portfolio. They provide exact interest payment timing, guaranteed face value return, barring default, known returns, and immunity to interest rate fluctuations if held to maturity. To get started with individual bonds, 1. Educate yourself on bond basics. That's why I'm here. 2. Determine your investment goals and risk tolerances. 3. Start with high-quality investment-grade bonds and keep an eye on the credit ratings of the bonds you own. If they start getting too low for your risk tolerances, swap them out for a higher-quality bond. It's better to take a little loss on a declining credit than it is to lose most of it because you held on to a bond and your bond went into default. 4. Consider creating a bond ladder for further diversification. 5. Monitor your bonds, but resist the urge to trade frequently. Profit-taking in a declining rate environment means investing in bonds that pay lower interest rates going forward. Remember to always consult with a qualified financial professional before making investment decisions. Your financial situation is unique, and what works for one investor might not work for another. See the full disclaimer in the description below. To learn more about investing in individual bonds, check out one of the videos on the screen now or subscribe to the channel. I would really appreciate it. Thank you so much for watching to the end.